I remember the exact moment it hit me. I'd been leaving thousands on the table without realizing it. I thought I was doing everything right by sticking with the reliable S&P 500 fund, just like every investing guide said. But then I came across another ETF that had been quietly outperforming it year after year. It wasn't riskier or complicated, yet almost no one seemed to be paying attention. That's when I started digging deeper, because if the safe choice could be costing this much, maybe the real risk isn't in trying something new, it's in assuming you're already optimized. That's where the real story starts, the hidden cost of playing it safe. The familiar comfort of buying a broadband index fund like VOO and leaving it untouched feels almost foolproof. It's simple, low cost, and backed by decades of historical success. You're not trying to outguess the market, you're just letting it work for you. But beneath that sense of security, something subtle happens over time. Each year that passes, a small slice of potential return quietly slips away, and most investors never notice until the compounding math makes it impossible to ignore. Most people follow this path without question. You open your brokerage app, type VOO, and buy. Done. You've heard the advice 1,000 times. Buffett recommends it, and it beats most active funds. But taking the default route can come with an unseen trade-off. Once simplicity becomes synonymous with safety, curiosity stops. You stop asking whether there might be a smarter option that follows the same disciplined, long-term approach, but are built to capture a little more of the market's growth. That's where the opportunity cost starts adding up quietly and consistently. Let's put this into perspective. Suppose two investors each start with $10,000. One buys VOO, the well-known S&P 500 ETF, while the other invests in a fund designed to capture momentum within those same 500 companies. Over the past decade, that difference translated into about 14% average annual return for VOO versus around 18% for the more targeted approach. On paper, that 4% gap doesn't sound like a game changer, but thanks to compounding, it's massive. After 10 years, the VOO investor's account would grow to roughly $37,000, while the other would reach about $52,000. That's over $15,000 in missed growth. Same starting point, almost identical risk profile, different outcome. Now, stretch that difference across 2 decades. Add a consistent 14% return. That original $10,000 compounds to about $137,000. But at 18%, the same investment climbs to nearly $274,000. That's a gap of more than $136,000, all from a seemingly modest edge in annual performance. This isn't about market timing or speculation. It's simple math playing out over time. The longer you hold, the wider the gap grows, because every percentage point compounds on top of the last. The psychology behind this is understandable. Index funds offer peace of mind. You don't have to worry about choosing the right stock, and that makes it easier to stay invested through volatility. That emotional stability is valuable, but comfort can come at a measurable cost. It reinforces the idea that lower perceived risk always equals better long-term results. In reality, efficiency matters just as much as safety. A more selective approach, one that consistently removes weaker companies and shifts towards those showing sustained strength, can still be diversified, passive, and disciplined. It's just more refined. To be clear, there's nothing wrong with traditional index investing. It's helped millions build wealth and stay consistent through every market cycle. But passive doesn't necessarily mean optimal. Treating the S&P 500 as a one-size-fits-all solution ignores the fact that data-driven ETFs now exist to enhance the same principle, capturing the best of the market while maintaining broad exposure. These funds aren't exotic or risky. They use transparent rules and periodic rebalancing to tilt towards performance rather than inertia. While most investors still default to just buy the index, a smaller group is quietly taking advantage of this evolution. They're not chasing short-term fads or betting on speculative sectors. They're using smart indexed ETFs that automatically reward momentum and trim weakness, all within a framework that looks just as simple on the surface. It's the same philosophy of consistent, long-term investing, but tuned more intelligently. And once you see how clearly those extra returns compound over time, it changes how you think about what safe really means. Because there's one ETF in particular that's been doing exactly this, steadily outperforming the classic index fund with discipline, not drama. And yet, hardly anyone seems to notice. That's where one fund stands out, the ETF that breaks the mold. It's not new, flashy, or themed around the latest market craze. Instead, it quietly applies a smarter structure to the same group of companies most investors already own. This ETF doesn't chase trends or try to predict the next big winner. It simply filters the S&P 500 through a different lens, favoring stocks with sustained strength over those just coasting along. And that small design change has made a measurable difference over time. While a traditional index fund like VOO owns all 500 companies, leaders and laggards alike, this ETF focuses on roughly 100, the ones actually driving most of the market's gains. It's not guessing which industries will surge next or relying on someone's opinion about what's hot. Instead, it uses hard data. Every 6 months, its system identifies which stocks have demonstrated the strongest momentum, those consistently performing better than their peers, and rebalances accordingly. It's a disciplined process that blends the steadiness of indexing with the precision of performance-based selection. The fund is called SPMO, the Invesco S&P 500 Momentum ETF. At first glance, it looks like any other S&P 500 tracker. But beneath the surface, its rules create a completely different dynamic. Twice a year, SPMO reviews the entire S&P 500, ranks every company by its momentum score, a calculation of how strongly that stock's price has been rising, and then focuses on the top performers. The lower-ranked companies quietly drop off the list. That rebalance keeps the portfolio fresh and focused where the data suggests strength, not where sentiment or size dictate it should be. The idea behind momentum investing isn't new, but SPMO makes it accessible. The principle is straightforward. Stocks showing consistent strength often continue that pattern for a while before trends shift. This doesn't mean endless growth. It simply reflects that performance trends to persist in the short to medium term. Professional traders have used this insight for decades, but SPMO automates the process through transparent, rules-based rebalancing. The result is an ETF that anyone can own and benefit from without having to track charts or time entries. If the S&P 500 were a basketball league, SPMO would be the all-star roster. It doesn't replace the league, it highlights the players currently putting up the best numbers. As with any all-star team, the lineup changes regularly. Every 6 months, SPMO benches the underperformers and adds those rising in form, ensuring the portfolio doesn't carry dead weight. Traditional index funds can't do this. They hold on to every stock, regardless of whether it's driving growth or dragging behind. That's where SPMO's design quietly compounds its advantage. The cost difference is minor but worth noting. VOO charges about 0.03% annually, while SPMO comes in at 0.13%. It's a small gap that often turns investors away, but what that extra tenth of a percent buys is structure, a systematic method that continuously reallocates towards proven strength. There's no fund manager making judgment calls, no emotional reaction to headlines, just a steady, math-based process aimed at maximizing efficiency. If that slightly higher cost yields better compounded returns over time, the difference becomes trivial. Many investors resist momentum strategies because the concept can sound like chasing winners. But SPMO isn't about jumping into hype stocks or guessing the next rally. It uses objective data and a consistent schedule. Its methodology is published and transparent, allowing anyone to see exactly when it rebalances and which holdings qualify. That's what separates it from speculation. It reacts to real results rather than narratives. SPMO ends up sitting in the middle ground between passive and active strategies. You still get diversification, simplicity, and low cost, but you also gain an intelligent mechanism that shifts with the market in real time. It's methodical rather than emotional, an approach that strengthens during expansion phases and adopts quickly when conditions start to change. And that adaptability raises an important question. How does a momentum-focused fund behave when the market turns volatile? Because it's one thing to thrive during bull markets, but resilience is truly tested when things get rough. What happens when the market turns against you? That's where the real test of any strategy begins, and it's exactly what shows how SPMO handles the storms. For a momentum-based ETF, the natural assumption is that it will stumble hardest when conditions shift. After all, if it's built on chasing strength, what happens when strength disappears? It's a fair question. But when the data is examined, SPMO's track record during turbulent years reveals a pattern of quiet resilience rather than collapse. Take 2018, when trade tensions and global uncertainty rattled investors. The S&P 500 ended the year down about 4.5%, dragged lower by a volatile fourth quarter. SPMO, however, slipped only around 0.9%. It wasn't immune to the pullback, but its rebalancing process, rotating out of weaker names late in the year, helped it sidestep a good portion of the decline. That difference might seem modest, yet it highlights how the fund's rules-based approach allowed it to adjust rather than absorb every hit. Then came 2020, a real stress test for nearly every asset class. In March, markets plunged as the pandemic triggered the sharpest sell-off in decades. Both the S&P 500 and SPMO fell swiftly, but the recovery path told a deeper story. As the rebound took shape, SPMO's biannual adjustment had already realigned it towards technology and consumer-focused stocks, the sectors leading the recovery. That repositioning wasn't a prediction. It was a reaction baked into its process. By following measured momentum rather than emotion, SPMO climbed back to pre-cash levels noticeably faster than the broader index fund. Fast forward to 2022, when inflation and rising rates sent markets into another tailspin. VOO, the traditional S&P 500 ETF, finished the year down roughly 18%. SPMO ended lower too, but by around 10 to 12%, both negative, yet the gap mattered. A portfolio that loses 18% needs about a 22% gain just to break even. One that falls only 10% needs closer to 11%. Over time, smaller drawdowns shorten recovery periods and preserve compound growth, the foundation of long-term performance. So what gives SPMO the ability to limit downside exposure in these scenarios? The answer lies in its structure. Every 6 months, it reevaluates the entire index, trimming fading leaders and rotating towards sectors showing steadier relative growth. When markets grow defensive, favoring staples, energy, or healthcare, the ETF naturally tilts that way. And when risk appetite returns, it pivots again, emphasizing growth-oriented names. The key is that this shift happens systematically without human bias or speculative timing. Unlike a static index, it doesn't cling to yesterday's winners or retain the dead weight of declining sectors. This is why quantitative strategies describe momentum investing as adaptive exposure rather than higher risk. SPMO isn't trying to escape volatility, it moves with it, continually seeking where resilience already exists. That adaptability helps reduce the duration and severity of drawdowns while allowing upside potential when optimism returns. Charts from recent years show that SPMO often recovers its previous peaks months ahead of the standard index, simply because it rebalances into strength instead of waiting for laggards to catch up. For investors living through these cycles, the day-to-day experience feels less like thrill-seeking and more like steady recalibration. There's no guessing, no gut decisions, just a disciplined process repeating on schedule. During turbulence, that consistency becomes its own kind of safety net, helping investors stay invested when sentiment turns fearful. And while momentum will always face critics who expect sharper drawdowns, the evidence from recent cycles suggests SPMO's rules-based rotation often cushions a blow instead of amplifying it. Ultimately, this kind of resilience doesn't eliminate risk, but it changes its shape. SPMO proves that momentum doesn't have to mean fragility. It can mean adaptability. And when a strategy can stay composed through panic and recovery alike, the question shifts from, can it survive a downturn, to how should you integrate it thoughtfully into your portfolio? That's where strategy comes in. Using SPMO the smart way. It's not about replacing what already works in your portfolio, it's about enhancing it with purpose. Because while SPMO's track record is impressive, no single fund should carry your entire plan. The real edge comes from blending it intelligently with your existing core holdings, balancing potential with stability. The surprising part is how even a modest slice of SPMO can noticeably shift your long-term results. Since it captures momentum within the same S&P 500 universe, Adding it doesn't overhaul your entire approach. It simply adds efficiency. The question isn't whether to go all in. It's how to fine-tune your mix so the power of compounding works harder for you. Many investors instinctively default to simplicity. 100% in VOO, set and forget. But letting one fund do all the work can leave growth on the table. SPMO is designed to complement that foundation, not replace it. A practical way to think about allocation is by framing it around comfort with risk. A conservative investor might lean heavily on broad index exposure, say 90% traditional S&P 500 or total market funds, paired with 10% in SPMO. That small portion gives you a taste of higher momentum returns while keeping volatility almost identical to a standard index. The moderate investor might aim for closer to a 70-30 split, with more weight in SPMO. You start to capture more of its rotation effects, which can boost long-term growth while still remaining manageable. Then there's the more aggressive approach, 50% core index, 50% SPMO. This blend suits investors who can tolerate sharper short-term swings in exchange for potentially higher compounded returns. None of these allocations is a fixed formula. They're starting points to tailor based on your time horizon, goals, and ability to stay disciplined when markets fluctuate. SPMO isn't built to act as the bedrock of your portfolio. Its advantage lies in momentum, not anchoring. Think of it like premium fuel. It enhances performance but still relies on a reliable engine. Your broad index fund is that engine. It keeps your portfolio steady during unpredictable stretches. SPMO simply gives you a higher gear when momentum drives markets forward. Used as a performance enhancer rather than a replacement, it strengthens your overall structure without disrupting its balance. That said, focusing on around 100 momentum-heavy stocks does bring concentration risk. When leadership clusters in sectors like technology or communications, it can create larger wings in names such as NVIDIA or Meta. Great when those stocks soar, more challenging during abrupt sector rotations. That's the natural trade-off for focusing on strength. The key is pairing SPMO with diversified holdings, broad market ETFs like VOO or dividend funds such as SCHD to smooth volatility. Including some bond exposure can temper fluctuations even more, creating a blended structure that grows efficiently without testing your emotional endurance during downturns. Over time, even small differences in return compound into meaningful wealth gaps. Imagine two investors starting with $100,000. The first invests entirely in VOO and earns an average annual return near 10%. The second puts 80% in VOO and 20% in SPMO, lifting the balance rate to about 11.5% based on momentum's historical tendencies. Across 20 years, that 1.5% spread turns into roughly $103,000 more, nearly a full extra portfolio's worth of growth, achieved without higher fees or speculation. The real discipline isn't in picking the right allocation once, it's in sticking with it. Momentum investing works when you stay invested through its full cycles, letting the rebalancing engine operate as designed. Trying to jump in and out or chasing quarterly leaders undermines what makes the system efficient in the first place. SPMO already handles the heavy lifting behind the scenes. Your role is to give it time and consistency. The smartest use of this ETF isn't aggressive trading. It's careful refinement of your overall approach. Because investing isn't about following the crowd or finding the flashiest fund. It's about quietly optimizing what you already do well. So your decisions compound into something bigger over time. And once you understand how to use that edge intentionally, it changes the way you think about what playing it safe really costs. True investing growth comes from intention, not comfort. Playing it safe isn't always safe. Sometimes stability can quietly cost you the progress that builds real freedom. Sticking to what feels comfortable might protect you from short-term missteps, but it can also keep you from long-term growth. The real skill lies in knowing where comfort ends and opportunity begins. ETFs like SPMO prove that disciplined, data-driven investing doesn't mean abandoning simplicity. It means refining it with purpose. So, are you letting the market carry you, or are you steering your results with intent? Share your core ETF mix and how you'd refine it after seeing what hidden momentum can do.